Good morning once again, options traders, and happy hump day to everyone. And I hope that everybody's getting ready for a very big and safe 4th of July weekend. But in the meantime, we have another good question that came up from one of the traders in our group. And we had talked about fair value in a lot of previous videos. And this person said, in your videos, you keep talking about fair value is this idea where it's a price where the buyers and sellers are expected to break even in the long run. And his comment was that this makes absolutely no sense because in the real world, let's say with insurance, they're going to pad that a little bit. They're going to have to build in a profit. Nobody's going to, let's say, go into business as an insurance company selling insurance at fair value because they would just be expected to break even. So this whole definition makes no sense. Fair value should include a profit. The definition shouldn't be it's the point where they break even. Okay, good question, good comment, but is it really valid? Why do we say that fair value is the point where the buyer and seller are expected to break even? So let's go find out more. And as always, before we do, please be sure to click like, hit the subscribe button. It's greatly appreciated and helps to promote the channel. So I'm going to start off with a little game. And let's say that I give you the opportunity to bet $1.50 to make 4. And I tell you that it's fairly valued, or you just assume that it's fairly valued, on the premise that I'm entitled to a profit. So therefore, it must be fairly valued. What a great deal. Well, but what if I changed the prices? What if I made it to where you had to bet $1.75 to make 4? Must still be a great deal because I'm entitled to a profit, and therefore, it's a fairly valued bet. Because this is real world stuff. I'm going to not charge fair value, I'm going to pad it with a profit. So therefore, this is a fairly valued bet. But I could also say you have to bet 2 to make 4. Same game, I'm just changing the price. Well, according to this person's definition, this would make a whole lot more sense to say that this is fair value. Well, what if I said you had to bet 3 to make 4? See, where I'm going with this is that you have no reference point whatsoever. You're just saying it's a set of numbers. I'm just going to take this person's word for it that it's fairly valued because he's entitled to a profit. But how can you make comparisons if that's your definition? In order to make comparisons, you'd have to say, well, what's the point where both people are expected to break even? And now we can make adjustments for the real world and say, okay, we're not going to expect that for a price, but how far away are we? And if we don't do that calculation, you will never know. So take a look at these 4 bets. Which one do you want to make? They might all be good. They might all be horrible. We don't know. It's the same bet. They're just different prices. Now, of course, if that's all the information you had, you'd rather take the one to bet the lowest amount to make 4. But still, does that mean it's a good deal for you as the buyer? So this is where the whole concept of fair value comes in. So what's this game? So do you see what's happening here? I'm just giving you prices, and again, that was according to this person's comment that this is all you need to know, that they're expected to make a profit, and this makes a whole lot more sense. But now, hopefully what I'm trying to show you is that we have no reference point for comparison. So now let's venture into fair value, and what's it going to tell us? Well, here's the game. We've looked at this before. I'm going to change it up a little bit. We're going to throw 10 numbers into a hat, and I'm going to allow you to win if you pick the numbers 1 or 2. So now you have 8 ways to lose, and you've got just 2 ways to win. So we would say that that's 8 to 2 odds against you. You have 8 spaces working against you for every 2 in your favor. 8 here in red, 2 in green. Of course, we can reduce that to 4 to 1. Now, because the odds are against you, you have more spaces working against you, we would say that the odds are 4 to 1 against. The person on the other side of the bet would have 1 to 4 on, meaning that they are in that person's favor. And some people might actually call it 4 to 1 on, but the word on means that it's in their favor. They're taking the favorable side of the bet. So now the question is, well, what's this worth? See, that's really what we have to do as traders. Okay, we might not expect that in the real world, but what's it worth? We need a reference point. So if we knew that it was a 50-50 shot, let's say flipping a coin, you would have to bet $1 to win $1. And if you think of a seesaw, maybe if this is a 1 pound weight over here on the left and a 1 pound weight over here on the right, these are the amounts that we have to bet versus the rewards. And they're equal, dollar for dollar. And what's making the seesaw balanced is that they are equidistant from this balancing point here, called the fulcrum, right, in a seesaw, and it balances. That's why we want to know where fair value is. What's the basic reference point? But now for this game, what happened? I changed it to where you have 4 times as many spaces acting against you as you do for you. So the seesaw is clearly not fair. So what could we do here? Well, under those conditions, now that we know probabilities, you have 4 times the number of numbers working against you as you do for you. And so we can see that in order to balance the seesaw, a 1 pound weight isn't going to balance a 1 pound weight with our little balancing point way over here in this 4-to-1 ratio. But what I could do is I could change the size of this weight. I could make it 4 times as heavy. So notice what I've done over here on the left. I have $1 times 4 is 4. And on the right, I have $4 times 1 is 4. So I have 4 on the left equals 4 on the right. So now I know that the basic starting point, the fair value, is that you should have to bet $1 to win 4. Now, does that mean in the real world that that's what you're going to get? Well, if it's some type of a casino or something, of course not. But at least you now know what you're dealing with. You know how much of an edge is working against you. So that's again where the idea of fair value comes in. So here we have a 1 in 5 chance, right? You had 2 ways to win out of 10, which is 1 out of 5. Now, yes, the odds are 4-to-1, but the probability is 1 in 5 times the $4 reward comes up to 80 cents. If there's a 1 in 5 chance of winning, there's a 4 out of 5 chance of losing $1, and we get our minus 80 cents. So we combine these, plus 80 combined with minus 80, and we get 0. And if we have a net 0, that means that this is a fairly valued game. The seesaw is in balance. So again, notice over here the probabilities. Look at just the numerator, 1 versus 4. So I've got 4 times the number of spaces working against you, but to balance it, I've given you 4 times the possible reward. You have to bet $1, but you can win 4. And so now it's in balance. And again, does that mean that's what we should expect to see in the real world? Of course not, but it misses the point. Because now let's go back to the games that I offered. And even if you choose this going, well, hey, this is a great deal. It's the cheapest one. I can pay $1.50 to make 4. What a great trader I am. And of course it's fairly valued because this guy's entitled to a profit. So you've got no reference point if somebody just tells you this is fair value. So now what's going to happen if you pay $1.50 to make 4, given that we now know fair value is $1? Well, obviously that's not going to turn out well. So let's jump over to an Excel spreadsheet and see just how bad it's going to get. Okay, so over into this Excel spreadsheet, I've set this one up to where we can actually change the reward and the amount that we're betting. So I'm going to give it a $4 reward. We are betting $1. It's calculating 4-to-1 odds. And I can change the numbers in the hat. We have a random number from 1 to 10. You're going to win from 1 to 2. So I can change these, but right now we're in balance. So see, that's important. Now what I can tell is that in the long run, we would just go sideways. So these green lines are plus and minus 1 standard deviation. The red lines are plus and minus 2. So watch what happens if we do this over and over. Now here are 10,000 tries at this game. So you can see that on average, we should just go sideways. 68% of the time we should stay within the green, 95% of the time we should stay within the red. But you can see that there are certainly times that we can end up on the winning side, even though it's a fairly valued bet. And we can also end up on the losing side, even though it's a fairly valued bet. But overall, we're just going sideways. And if we sat here long enough, we absolutely, with 100% certainty, would come back and cross 0. But just take a look at some of these. So just notice that overall there's no real discernible trend. It's just going sideways, and that is because it is a fairly valued bet. But now let's change the price. See, now we've got a reference point. We know that we should be paying $1, the fair value, but I gave it to you for $1.50. Well, is that good or bad? See, if fair value was $1.49, then $1.50 isn't bad. But if $1 is fair value, $1.50 is just off the charts. But how would you have known? Because you have no reference point. So let's make this $1.50 and watch this black line over here. Look at that. This is no bet that you want any part of. How did we know? Because I can see that you are 50% of the way from fair value. I can tell that the fair value is $1 and you're being charged $1.50. So look at that. It's just not good. What happens if you pay $2? Only going to get worse. Steeper line. Charge you $3, just going to get worse. Charge you $4. You can see that none of these are anything that you want a part of. So even though you thought you might have been doing well by picking the cheapest one at $1.50, congratulations, you just sent yourself into guaranteed losses in the long run. But if you didn't have a concept of fair value, you would have thought, hey, this is as good as it gets, $1.50? Sure, he's entitled to a profit. That's fair. That's a fairly valued bet. So do you see the difference now? No, nobody's expecting that if the fair value is $1 and this were, let's say, some type of an insurance company or a casino, that you're going to actually bet $1. The reason we want to know fair value is that it tells us how good or how bad the bet really is. So let's try another one. Here's roulette. We've looked at this before. If we look at this single number bet, Vegas will pay you 35 to 1. What a phenomenal risk-reward ratio. And that's how a lot of traders look at it. They're just looking at these risk-reward ratios. It tells you nothing. And you can't look at this and say, well, you know, Vegas is entitled to a profit, so therefore it's fair. We need to say, where is the balancing point? And then we can figure out how far away we are from being in balance or from fair value. So fair value at roulette, there's a number of ways we could look at it. I could say there's a 1 in 38 chance, right? There's 38 spaces on the roulette wheel that you can win the $35 prize. We multiply these out, we get a little over 92 cents. If there's a 1 in 38 chance of winning, there's 37 out of 38 chances you're going to lose your dollar. Multiply these out, we get 0.9737 minus, because you would be losing $1. And now the net is minus 0.053. And this is what we would call the house edge. On average, Vegas is taking a little over 5.3% of your money. We're assuming that you're betting $1 each time, and you're basically throwing 5 cents away. So like I've said so many times before, mathematically, if your friend is playing roulette, betting $1 at each spin, and you're standing next to him flipping 5 cents into a trash can, mathematically, both of you are doing the same thing. But how would you know if we don't have a reference point? That's why we look at fair value. So over here we can see that there are 37 more spaces acting against you, right? There's 38 total. You're going to win on one of them, but there's 37 acting against you. But look over here. There should be 37 times the reward, and Vegas is paying you 35 times the reward. See, now it becomes obvious because we had a reference point. Now this is looking at it in terms of the payoffs. We could look at it in terms of what they're charging you. Lots of ways we can look at it. We could say there's a 1 in 38 chance of winning $35. Multiply that out, we get 0.921. And there's 37 out of 38 ways of losing your dollar. We get minus 0.946. And if we do that, that's going to give us 0. So what I've done here, instead of saying what is the edge, I'm saying what is the price that would make it fair. So now we can see that Vegas is charging you $1, but they should be charging you a little over 94.5 cents. Not too far off of fair value. Should be paying, let's call it 95 cents, and they're charging you $1. But how would you know that we're not too far off? Because if you go back to this person's definition, they could charge you $2 and we'd say, oh, that's fair. Because in the real world, they have to pad it so that they have a profit. Or they could charge you 3 or 4. We don't know because we're just going to assume that's fair because it's the real world. Well, hopefully now you see why that's a bad idea. We have to have a reference point, and so we need to start with fair value. And sure, in the real world, we're not going to expect to get it for that, but that's the whole point. As an options trader, you need to figure out how far away you are from what appears to be a fairly valued bet. So for instance, let's go over to the tastytrade platform and take a look at an example. So now we're into the tastytrade platform. I'm going to use NVIDIA. I'm just going to pick up this expiration here, 31 days to go. Now the stock closed at, let's call it 153. And for some reason, we want to buy the 150 put. And it's trading at 490. Let's just call it $5. Does it make sense to go, oh yeah, that's a fairly valued bet right there. That's the fair value because the seller is entitled to a profit. Nobody's going to sell it at fair value, so therefore I should jump on this because I'm a good options trader and I just know that's fair value. Well, how do you know that fair value isn't 480 or that it's 2? See, there's no way to tell if 490 is high or low because we have no reference point. That's why it's just a bad idea to say that we're going to expect them to pad it with some type of profit and therefore that should be the fair value. So now you can see what options trading comes down to. What we need to do is to say, how big is this price, again, roughly $5, relative to this volatility, relative to this amount of time? And if based on our assessment that the fair value of the option is $3, in other words, our implied volatility is much lower than this, then we should lean towards being a seller. We should be a liquidity provider. On the other hand, if we come up with an assessment that the future volatility is going to be much higher than this, and we think it's worth 7, then we should certainly be willing to pay 5. But notice that we're doing it because we're coming up with, now in options trading, it's an arbitrary fair value because we have to assume volatility. And now you can see why volatility is the name of the game, not $4.90. We have to say, how big is that relative to some benchmark? What's that benchmark? Fair value. So I hope that helps you to see why fair value is a mathematical concept. It's a balancing point. And we do it because it gives us a reference point to compare the real world prices to see just how high or low they are. And if we feel they're too low, we should be a buyer. If we feel that they're too high, we should be a seller. But again, there's no way to know that until you start with fair value. And for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. You can find it all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.